Before we begin, please take a moment to review this critical regulatory disclosure. All financial figures, return rates, and capital values presented in this video represent simulated historical or forward-looking results generated by System Dynamics' Monte Carlo mathematical model. All returns and capital evolutions are explicitly shown in real inflation-adjusted terms to account for extreme macro fluctuations. Simulated performance does not guarantee future results. All investments involve substantial risk, and you should deploy capital only with outside professional advisory discretion. The next 50 years will bring an industrial revolution that dwarfs any terrestrial precedent. In this video, we will analyze the quantitative results of a 5,000-run Monte Carlo simulation of the solar system's economy from 2026 to 2076. We will explore how off-planet physical automation and terrestrial cognitive automation will reshape global investment portfolios, compounding a $100,000 baseline into billions of dollars in real, inflation-adjusted wealth by escaping the gravitational and regulatory boundaries of Earth. Let us examine the individual sector growth rates from our simulation results. Across our core baseline, the pure space sector compounds at a median real, inflation-adjusted annualized rate of 18.72%, driven by hyper-compounding robo-factoring loops in low gravity. The artificial intelligence sector benchmark compounds at 17.84%. Traditional terrestrial equity benchmarks, represented by SPY, grow at a respectable 12.18%, boosted in the middle decades by white-collar automation, but eventually hitting local central banking liquidity traps. How does this automated revolution reshape human society? Our model reveals a stark division across four global demographics. The wealthy, possessing massive off-planet equities, can secede their assets and enjoy compound returns completely free from Earth's tax boundaries. Middle-class white-collar workers initially benefit from productivity, but face severe employment collapses and income compression as cognitive AGI achieves full saturation. Conversely, blue-collar workers experience a dramatic drop in the cost of basic consumer goods, expanding their real purchasing power. Meanwhile, the extremely poor in developing nations gain access to cheap space-beamed solar energy, yet risk permanent economic decoupling from high-value orbital trade. Let us look at the early decades of the simulation. Why is a pure 100% S&P allocation optimal in Decade 2? During this period, AI reaches 100% white-collar adoption. Traditional corporations in SPY capture massive profits by automating expensive professional administrative overhead while maintaining high revenues. This creates a low-volatility profit surge that makes SPY the superior risk-adjusted choice. During this era, direct AI investments are too volatile, while the space sector is still burning cash to build deep space lunar infrastructure. In the late decades, the optimal portfolio shifts aggressively back off-planet. By Decade 4, space industrial robo-factoring is highly mature, and the optimal allocation shifts to 60% space. By Decade 5, the allocation moves to 100% space. Why isn't holding SPY good enough, even as its space footprint grows? While SPY attempts to integrate space holdings, it remains fundamentally anchored to Earth's crashing tax jurisdictions, central bank liquidity caps, and regulatory nationalization traps. Only a dedicated off-planet space allocation escapes these planetary constraints. Modern portfolio theory assumes that asset relationships are stable and markets are liquid. However, off-planet automation and massive supply-side deflation destroy these traditional correlations. When space-based robotics begin exporting massless energy and raw refined materials to Earth, it triggers a severe deflationary shock. Terrestrial assets suffer cash flow declines, while sovereign debt burdens expand in real terms, causing traditional balance sheet models to break down and rendering planet-bound diversification strategies obsolete. Let us examine asset beta sensitivity over our 50-year timeline. Beta measures how sensitive an investment is relative to traditional Earth equity benchmarks. In the first decade, space assets maintain a low beta of 0.4, representing a volatile, isolated sector. However, as space logistics integrate with terrestrial markets, space beta rises. By the fifth decade, as Earth falls into liquidity deadlocks and space companies transition to a sovereign state status, space assets have completely decoupled, recording a negative beta that serves as an unmatched hedges for capital flight. Alpha represents the excess returns generated over traditional capital asset pricing models. In our simulation, space allocation yields a massive premium. In the first decade, alpha rests at plus 1%. As AGI and physical orbital robotics achieve cooperative trade synergy, this excess yield surges. By decade 5, as terrestrial assets buckle under sovereign debt defaults and space conglomerates fully secede, space alpha peaks at a monumental plus 8.73% CAGR, capturing the raw productivity of the solar frontier. The great macroeconomic headwind in our simulation is the Earth liquidity deadlock. As space corporations scale production, they offer millions of tons of cheap imports. However, Earth's central banking frameworks and fiscal deficit constraints limit the available circulating currency on planet. Terrestrial banks hit a hard liquidity ceiling, triggering a persistent deadlock where physical cash can no longer flow back off planet. This trap highlights why traditional fiat currencies collapse, forcing space syndicates to transition to gold, energy, or decentralized token structures. To ensure absolute analytical rigor, our simulation executes details over 5,000 independent stochastic runs. Analyzing the probability distribution of portfolio yields reveals a wide spectrum. In the worst 10% of trajectories, marked by early hostile defection or severe global AI regulation, our compounded real portfolio returns are capped at $400 million. However, in the median case, cooperative trade and stable policy rebalancing generate $16.6 billion. In the best 10% of runs, featuring rapid space industrialization, portfolio values exceed $100 billion. This data highlights a vital financial lesson. Traditional physical-only assets become obsolete as space-based automation bypasses terrestrial boundaries. By understanding risk-adjusted Sharpe ratios, decadal rebalancing loops, and capital flight mechanics, investors can position themselves where real productivity is highest, ultimately seceding from planet-bound regulatory and monetary ceilings.